So what does it actually take to purchase a home? Today, we're going to get into the buffet of loan programs that are available to you guys and get into some of the details for those of you who maybe don't know. So, conventional loans, it's not conventional or bust anymore. Other kinds of loan programs are being accepted. So we want to get into some of that today. We're getting into it right now. Hey, ladies and gentlemen, if you're looking to learn more about what it's like living in Dallas, Texas, well, this is the channel that helps you do that. So I invite you to subscribe down below. Make sure you tap the bell for notifications so you can stay up to date on the current market here in Dallas. My name is Jimmy, your local born and raised real estate expert advisor, and we're getting tons of calls and emails every single day from people just like you who are ready to make this move here to Dallas, and we absolutely love it. So if you are thinking about buying or selling here in the Dallas area, be sure to reach out and give us a call today so that we can help you make a tailor-made game plan just for you when moving to Dallas, Texas. But today, as mentioned, we're going to get into some of these loan programs with these two esteemed gentlemen that I have before me. Ladies and gentlemen, this is Daniel and Jeff.
Hello.
My preferred lenders. And so for those of you, if you've purchased a home with us already, you probably already know these guys, but for those of you who are new to the program, these are, you'll probably be speaking with these gentlemen right here, just to get any of the mortgage side, those kinds of questions answered, and they might even do your deal. Who knows?
Right.
But, guys, I think let's do a brief introduction for those of you who don't know. Maybe talk about, how long you've been in the industry. I think Jeff's been in a little bit longer.
Yeah.
Daniel's still got hair. So
you can see that, right? The
He's
hair.
definitely got more hair of
Yeah.
all of us, I think.
Yeah.
Jimmy's maybe has the most hair.
Yeah, Jim he hasn't been in it for that long. Yeah.
Finance business takes it out of you quicker.
Yeah.
So when you do finance. So yeah, I've been doing this about 24 years. And when I started, I had a full head of hair. And it's been quite the ride. We went through the 2008. We've talked about that in one of the podcasts and what happened back in the housing crash 2008. And so we've got a little bit of a dip going right now. And I think it's just, very minor, honestly. I don't think it's going to affect the market very much. But yeah, we are ready to kind of dive into helping people talk about what, kind of down payment you're going to need to get into a house.
Awesome.
I started in 2010, so 12 years, Jeff. We worked together.
12 years together.
12 years. So
and we played tennis
team.
together.
Yeah, dream team. Yeah.
He taught me tennis about, 17, 18 years ago?
Yeah, 2001. Yeah. It's been a while.
Yep.
Yeah.
And that's how we all know each other.
Yeah.
If you've watched any of my other videos, I'm talking about tennis. I'm finding the nearest tennis court in the neighborhood, type of thing, challenging anyone who wants to get this smoke. Come and get me. The only person to beat me at this table is Daniel.
I haven't got that call yet. Yeah, I haven't got the challenge call yet.
I don't know that Jimmy and I have played, and I have.
That's right.
Yeah.
I don't know.
So I'm semi-retired at the moment, but I will come out of retirement if I need to.
Yeah.
So anyway, these guys are a bunch of fun, but still very, very professional. What I love about these guys is their professionalism. Their the level of communication is unbelievable from you guys. So,
Thank you.
Listen, I think, people have, the truth is, right, you have a choice of what lender you go with. I think a lot of it comes down to the math and which, who's going to get you the best deal for you. Right. But also, the other variable at play is, how fast can you close on time? The communication that you have with the agent, just so everybody's on the same page there, and there's no guessing at any point in the deal, right? Mm-hmm. And so I've had, we've worked a few deals here together with these guys, and it's been nothing but a pleasure. So we'll get you guys connected if and when the time comes, right? So. One thing, while we're talking about your choice of lenders, one thing I just want to mention real quickly is, when it comes to, if I'm the listing agent and I have, different applications coming in or offers coming in, I will tell you the ones that come from big banks like Chase, Wells Fargo, things like that, or like the Rocket Mortgage, things like that. Listen. Everything's great, but the problem is the ones that come from those kinds of institutions generally tend to take a little bit longer to get through because it's a numbers game for them. Right. Like I used to work at JP Morgan, and it was just churn and burn. Like I didn't really care about who, because I had another person in my ear the next second. Right. So the level of care was completely different at a big institution versus a local private lender, which is what you guys are categorized as.
Yeah,
so.
And they, they basically, they're transactional, right? And so, if you're sending your documents and making sure everything looks okay up front, they're not checking all that information. Yeah. So we're taking the information, we're going to check it, we're going to make sure you're okay, so that you don't, start spending money on that house, i.e. option money, inspection money, and then find out later you can't do a loan, and it happens more than you think.
Yeah. Most of the times they're also 8 to 5, right?
Right. Yeah. 8 to 5. You're not
going to. A lot of the issues can happen after 5 o'clock, and then you need your lender and you need to talk to them, right? So,
yeah, if I need a document on a Sunday at 3 p.m., nobody at Chase is answering the phone.
Right.
Yeah.
Sorry.
And I think one of the biggest ones that we lose in that is like we get on the phone and we say, hey, I'm going to put 20% down or 5% down or whatever they think they want to do. And really that company's an order taker, right? They're just going to take their order and say, hey, okay, that's what you want. Here's your terms on that. Whereas like what Daniel and I do is we're going to go through the loan with them and kind of talk about
personalization.
Do you really want to put that amount down? You've got all this debt. Why don't we put less money down, pay off your debt? And we just talk different scenarios that we look at it as, hey, this is an opportunity to kind of look at the big picture. So, that's something we do, every single time we talk to a client. Daniel has he was a financial advisor in the past. So, we talk about this stuff all the time.
Yeah.
Awesome. Yeah. So one thing, let's get into maybe one of the first things that you got to have when you're talking about purchasing a home is let's talk about credit. Okay.
Right.
Now, for those of you who, have the Beacon credit scores, this might not affect you, but for those of you out there, maybe first time home buyers, especially, you guys will definitely want to pay attention to this part. So, listen, I know each program, and we'll kind of touch on each one because they're different within each program.
Right.
Yeah.
But generally speaking, from y'all's perspective, what do you guys want to see? Like, there's always the talk about, don't start an application on a house and
don't
then
pull your credit.
Go buy a car.
Right.
Yeah.
Right.
Right. Like don't be doing stupid stuff like that. But for some people, they just it's innocent. They're like, oh, I'm gonna get a house. I might as well get a new car too.
Right. They have no idea. And so, there's a lot of little things there that, like a lot of myths that go along with it as well. But, the biggest thing that we say is even if you have the highest tier credit, or you think you do, when you see what you see online, like when you go online and Credit Karma or any of the online ones, that when we pull credit, we're going to have a different credit score than they are. It's a different algorithm.
Different scoring model.
Right.
Yeah.
Right. And it's the same. It's also different for automobile, different for mortgage.
And credit cards.
And credit cards.
Yeah.
So that's number one. That's always that myth. Like, hey, my credit score is 810. I see it online. It shows that. Well, that's not the same credit score we're going to pull. It's it can come back. I've seen it 80 to 100 points difference.
Yeah.
I mean, it's crazy sometimes.
Most of the times, if you have a score, I would say over 760, it's pretty close. But if you're in the, I would say, high 600s, then there could be like a 20, 30 point difference on the score, like with the hard pull versus what you see on Credit Karma and so on.
Right. That's and the other thing too is that I always like to make sure everybody understands is everybody's hesitant on pulling their credit, but what they don't understand is it's 90 days that it affects your credit. So if you're not going to buy a car or get a credit card or student loans or anything like that in the next 90 days, there's really no effect to you by pulling your credit. So there's not necessarily this big negative that you hear about all the time, but it will bring your score down, but it's only for a short period of time.
So is it a soft pull or a hard pull? Talk about that.
It's a hard pull. So anytime you inquired for debt, it's considered a hard pull.
Okay.
Right. And you can talk about, if you're just going online to see your credit scores, that's a soft
pull. Yeah, which doesn't affect your score or anything like that.
Yeah. So anytime you guys are going to do that, there's no like preliminary, can I just kind of soft pull my credit to see what it is? It's always going to be a hard one for you guys. So it's going to be, it'll affect the score for 90 days.
Yeah.
Right.
And we can keep that
off.
credit report like from 90 to 120 days.
Right.
So
Okay.
without having to re-pull again and again, right?
Yeah. And then after that, you pull again, but you're reset anyway because the 90 days already came up.
Yeah.
So it's not going to affect you. So that's always the big myth. And I think another thing that I always want to throw in there is that, if I'm a consumer and I'm about to go buy a house, we always hear like, hey, I don't want to pull my credit yet because I'm about to go pay off a bunch of credit cards so I can improve my score. Well, the credit reports are delayed. They can be delayed up to 30 days. So if I pay it off today, then I got to wait 30 days before I can even see the results, in some cases of paying that stuff off. And the other thing along with that is talk to Daniel and I first because, we have credit software that we run behind there. It says, hey, you may not even want to pay this off. It may actually hurt your score if you paid it all the way off down to zero, which it doesn't make sense, but it's how it works.
Yeah. And obviously we don't recommend anyone to open up any liabilities during a loan process, but if you have to buy a car, if your previous car broke down or you have to do this and this, just talk to your lender so the lender knows what's going on, and then we can give you hey, you're good to go, or let's wait with opening up a credit, right?
Communication is the key.
Exactly. So it doesn't mean that you can't do it. It's just let your lender know what's going on in your life, because if we're all on the same page, it's going to be less likelihoods of any issues with the loan down the road.
And all these things only happen more with local lenders. So you have your Chase or Rocket Mortgage. It's just not you're going to be more of a guessing game.
Okay. Yeah, Danny, you mentioned something just a minute ago. I want to go back to that if we can about, it could be, a 20 or 30 point difference, which could mean a difference in the rate that you see.
Yeah.
Right. So, and talking about, you guys play this game every day. So that's why I want to really introduce and really, guys, if you have any questions, for these guys, I want to get you connected. So reach out, all the contact info is in the description down below. Make sure you check that out. And by the way, leave a comment if you have any questions, if we can answer for you in the future podcasts, let us know. And if you're finding value so far, tap that like button and make sure you are subscribed as well. So the difference between, 20 or, 30, 40, 50 points on your score could mean what?
It's going to affect the rate. So on a conventional loan, you're looking at, the rate improves for every 20 points, right? So you have a rate for 660 to 680, 680 to 700, and then every 20 points, the rate improves. Most likely it's, again, it's not always the case, but 1/8 is the improvement with a 20-point score improvement.
A lot of times.
Yeah, it's not every time, because the rates, they fluctuate on a daily basis. This is maybe too much information, but on the back end, sometimes it does give you those type of improvements. Sometimes it doesn't. So that's something we look at with the clients.
No, I like this. I think that's good information. It's just a good kind of rule of thumb. Obviously, it's not guaranteed, but just kind of what you can somewhat expect.
And FHA VA, it's not as sensitive for the credit scores as what a conventional loan does.
It's something to note here. Golly, excuse me. Wow, what just happened here?
You're going through puberty.
Right, apparently I am. See, I'm circling all the way back around. I've just circled all the way through.
Just the hair is not coming back.
Maybe it is. I don't know. We'll see what happens here in about an hour.
We need 30 days. We still don't know. It's the credit.
We'll check back on this on the next podcast. So one of the things that I think is important on that. So when we pull your credit, this is a big difference in mortgage companies. When we pull your credit, we're running software. So if we pull your credit and let's say it's at 700, and there's a big advantage between being at 700 and 740. There's a huge advantage there. Well, we have software that tells us how to get there. So we can actually improve your credit score while we're doing your loan. So you're not stuck just when we pull your credit. That's not the final credit score. So we do that quite a bit, and we'll kind of do it off to the side. So we're actually helping you fix your credit score to get you a better rate along the way.
Yeah.
So
yeah, that's why I like when people reach out to me, 6 months ahead of time.
Right.
Instead of, I've had people reach out to me, the same weekend. I've had people reach out to me on a Thursday, and we've gotten them closed and executed on a Monday before, right? But obviously that's a little bit different. But if you're thinking about, hey, maybe I should look into this, that's the kind of conversations that we want to have with you guys, and you guys want to have with Daniel and Jeff here.
It's all about putting a plan together, right?
Yeah, exactly.
So everyone knows, hey, here's what I need to do to be able to buy a house.
Yeah, and that'll let you know what your timeline is, right? You may be saying, hey, I'm thinking about buying it, but I need to figure it all out, and we'll talk through it, get a plan, and then you'll know what your situation is, and then you'll know what you need to go do.
Yeah, and there's no cost. It's mainly, right, you don't pay us anything to put a plan together. Right? Yeah, it's education.
Right.
Yeah. Mm-hmm.
Cool. Well, let's run through some of these programs.
Okay.
Y'all down?
We're ready.
Okay. So first, and the most popular, of course, is going to be conventional, right? Yeah. So conventional, a lot of people think, oh, you got to put 20% down, and this, and that. So, but talk about conventional and the insurance that's involved. Talk about,
So, I'll start on the conventional.
Go ahead,
first-time home buyers, they can do 3% down payment. You will have a private mortgage insurance, which is the private mortgage insurance depends on the down payment and also what the credit score is.
Yeah.
And then if you own the house, right, within a 3-year period, then you have to put 5% down. And the same thing there, the private mortgage insurance will go down a little bit with a higher down payment, but it also has to do with what the credit score is. So the higher the credit score, the lower the PMI. And that's what a lot of borrowers don't know, that the PMI, if you have a very good credit score, the PMI is not that much. Then it's sometimes better to put maybe 5% down less or 10% to save the cash, because the PMI is not that high. Now, I'm not saying that's for everyone, but it's an option. And a lot of people just look at the PMI as a hurdle, like it's a cost, which it is a cost. But if it saves you more cash, right, and you have it
bottom line.
Exactly.
You can pay off debt. So that, again, that's what Daniel and I are doing. We're kind of evaluating your situation, saying, hey, maybe put down less money. Your private mortgage insurance may only be $50 a month, which now you can go pay off all your credit cards and all this. I mean, you're going to save tons of money.
I recently had that with a client that bought an older house, and they had perfect credit score. It was $60 a month, but they saved about $60,000. So that money instead was going toward renovations instead of putting down 10% extra. And so you have instead gained more equity in the house because it's worth more now because of all the improvements, right?
Mm-hmm.
Yeah.
So now private mortgage insurance, PMI, is that for anything or any time you're below 20% on the, is that
correct?
Right.
Correct.
Yeah. So you can refinance it at 20% when you have 80% loan to value, right? But then at when you have 78% loan to value, you can technically go back to the lender and ask for to remove the PMI, but it has to be from the original value.
Right.
Okay.
So, yeah, I mean, you're not stuck in the PMI for the life of the loan. So if you start with PMI, it goes away once you've paid your loan down 22%, and you contact your servicer and say, hey, I'm there. They're supposed to do it automatically, but I wouldn't count on that.
Yeah.
Yeah, that's a good tip right there. You gotta like that one for the tip. But now let's define first-time home buyer as well, because my understanding is it's if you haven't bought a home in 3 years.
3 years.
3 years.
Yeah. So it's not like you only get one chance.
No.
Right. No. You can be a first-time home buyer many times.
Yeah.
Yeah, I think it's just they don't want to. It's for the investors who are doing them, churning and burning them. You can't. They can't take advantage of it.
Well, and they're usually looking at, like, when you own a home and you're going from one home to another, you have equity in your property, so you're going to roll it over, and they want you to put equity into the property. It keeps lower risk. But if you haven't owned a home in 3 years, then you probably don't have that equity, so you don't have as much money to put down. So that's kind of probably a little bit of the thinking behind it. And also, I want to back up a second on the private mortgage insurance. A lot of people get that confused with homeowners insurance. So on a loan, there's actually two different insurances. One is your homeowner's insurance in case the house burns down. One is the private mortgage insurance, which is only an insurance
to protect the lender.
Yeah, protect the lender for foreclosure cost.
Perfect. Yeah. Burning down or any major appliances going.
Roof. burn it down.
Yeah.
Some of it's flood. That's additional insurance, but we'll do that on another segment.
Yeah. Okay. So is that it on conventional?
I think so.
Yeah, I mean, in terms of the rates, like if you put down 25% on a conventional, sometimes you get a little bit of a rate improvement.
Right.
And what's strange too is occasionally the rate does improve with 15% down versus 20%, which is strange.
Yeah.
And sometimes it doesn't. But again, that's something we would talk to the borrower about.
And we'll get into the whys on that. It makes no sense at all, but there is a reason and a good reason, but I don't think that's too deep right now.
Yeah.
Okay. What about buying down points? Let's talk about that.
Okay. Yeah,
quick.
no. So, you can buy down your rate, usually like 1% of the loan amount. For instance, a loan amount of $500,000, 1% would be $5,000. And usually that would buy your interest rate down 1/4 of a point. And we just did a little math ahead of time on that. So 1/4 of a point on that's about $75 savings.
On a $500,000 loan amount. Yeah.
Right. Mm-hmm. So you can do the math on that. It's about a 5 to 7 year break-even point generally when you buy down. And, I'm not personally a fan of that because, the data tells us that you're only going to be in that loan probably 7 years or less. And that's almost 90% of the time. So if you start playing the odds there, you're probably better off not paying the points, saving the money, because if I had that $5,000 and 7 years from now, that $5,000 is probably going to be worth more than the $5,000 if I invested.
There's so many ways we can structure the loan, right, based on what a client is wanting. So if a client is only going to be in the house for a year to 2 years, well, have the lender pay for a lot of closing costs, go with a little bit higher rate, right, to get a quick break even. Or if someone says, you know what, this is going to be my final house, I'm going to stay here for a long time, well, look at buying down the rate and see what your break even is, if it makes sense to do. If you're not sure where how long you're going to stay, well, then just go with the market rate that the lender gives you. So there's a lot of ways to structure it, and when there's a lot of different information out there, and always look at the fine lines on the advertisements, how lenders are advertising the rate. Right. Most of the times they will advertise the rate with significant points or discount points to be able to show lower interest rate. And then it's a little bit deceiving for a consumer when they just see that low rate, but then they don't read the fine lines where the lender charges 1 or 2 points for that particular rate. Right. So it's a lot of education involved, and that's why you got to find a lender that's willing to take the time and talk about all the, hey, here is this, here is what the other lender is offering, and then you do it. Really, you're breaking it down and doing apples to apples comparison.
There you go.
Yeah.
Mm-hmm. Yeah, that fine print will get you sometimes.
Yeah.
Speaking of open door, got in trouble.
Yeah, right.
Make sure you watch that video. We'll put in a link.
That wasn't a surprise.
They were saving everybody a lot of money, apparently.
Quote unquote.
Yeah.
All right, cool. Let's keep it on track here. So let's move to the jumbo loans. So jumbo loans are for amounts over $647,000 and $200.
Yep.
Currently,
right.
That number changes
from
time to time.
Yeah.
So is it
year to year?
They change it.
Okay. Each year they evaluate it and they adjust it based on whatever the market is. So I imagine we'll have a pretty good little jump. I'm going to guess like about 20% this next year. But yeah, I mean so when you start getting into jumbo, what we really have to think about is your down payment minimums are much higher. So 10% in some cases you got to have much higher credit scores. It affects the rate quite a bit more if you only do 10% down on a jumbo. And the guidelines are a little tighter. So paperwork a little bit more is what we would say whenever we do jumbo. We're like, okay, we got to make sure we give everybody the information right up front of how much, what additional paperwork you're going to need. So, but we're looking at all that and evaluating it, and we check it all up front. But they're good loans. I mean, right now, even the rates on some of those are lower than they are than the regular conforming loans.
Same thing there. Higher down payment will give you a little bit better rate.
Right.
Yeah.
Right.
So, and I mean, 20% is recommended.
Yeah, I think in a jumbo, 20% is recommended.
And 25 obviously gives you that little rate, a little bit lower rate on that if you have the money.
Right.
So.
Yeah, perfect. Mm-hmm. Well, I think, in that kind of price point, those are options that are, certainly, viable.
Yeah.
They're Go ahead.
Yeah, and if you are going in that jumbo market where your loan amount is 647,200, well, there are other options, like you can add a second lien and do just 5% down. Again, second lien has their own rates, and then you do a first lien up to 647,200. So those are again options that there's so many options for borrowers, just that it's hard to know if you don't know what's available, right?
Or Daniel's throwing out he's throwing out all the numbers now. He's showing off here.
Showing up.
Yeah, so
where are those glasses?
Yeah, hold on, I forgot my glasses
again. You forgot them again.
Yeah.
Just throwing in the Swedish numbers.
Yeah.
So yeah, I mean, really, what you want to do is when your sales price gets a little bit above, you start getting at like 750,000, 800,000. You can still figure out a way. We can actually still do 5% down in those scenarios. Mm-hmm. So in some cases, so we kind of evaluate that and talk to the client. Whereas if you just call Chase, you're probably going to be putting 10 to 20% down.
Yeah.
So.
Yeah.
More personalization.
I'm not knocking Chase, by the way, for the record. I love you guys.
We love Chase.
Not at all.
I love you guys.
Former employer.
Yeah.
Personally too. So.
Oh, it was. Okay, there we go.
Yeah. Okay. We good on jumbo? You want to move to the...
I think jumbo, we're good.
Yeah.
I feel good about it.
The government-backed loans. Let's start with FHA.
Mm-hmm.
Let's talk about FHA.
FHA. So FHA is, they call it the first-time homebuyer loan because the down payment on there is 3.5%, and it's a little bit more flexible on the credit score. So, usually if someone has a credit score down to like 620, we can still do a loan on that. We can actually go down below that, case by case, but they tell us we can go down to 580. A lot of times that gets a little bit difficult to get our approvals through the automated system whenever you have a little bit lower credit score. But what we can do, like I said, we pull your credit and it's a 580 and it's not working. We're going to evaluate that credit and see how we can help you potentially get that credit score up really quick.
And it's crazy. Like if sometimes borrowers, they may have one small collection on it.
Right.
And that collection can maybe get their score up 70, 80 points just by getting it removed. And for some reason, maybe that borrower never received the letter of the collection. They don't even know about it. And just trying to get that deleted from the credit report can sometimes make a huge difference.
Yeah, it's huge. Like, and the one we see on there, I think I see on the most is like a cable box.
Yeah.
Like a $75 cable box that they didn't turn back in.
From AT&T?
Like AT&T.
Yeah.
Oh, we see that on Time Warner. I see that all the time.
Time Warner.
Yeah,
man.
and that knocks your score down like 80 points.
Yeah.
I mean, over a cable box. Come on, seriously.
Dude.
So dumb.
Yeah, I remember back when I had it, you had to go, there was only like one place you could return it over in like Garland or Mesquite or something. Yeah. And it was like just some brick government building over there.
Right. During business hours.
Where am I?
Right.
But anyway, so okay. Yeah, so FHA.
So FHA,
is more
first-time home buyer, 3.5% down. And again, it's a little bit more flexible. So if you're coming in and you've had a credit situation, hey, you went through a divorce. We see it all the time with the divorce. The issue with FHA is your maximum loan amount, I think, is what, 450?
450, yeah.
450,000 is your maximum loan amount. So sales price can go a little higher, but right now that is the maximum loan amount. And again, that changes every year as well.
Mm-hmm. Cool.
So on the FHA, you're going to have a mortgage insurance.
Right.
On the conventional, it's called private mortgage insurance. And you also have an upfront mortgage insurance on FHA that goes on top of the loan amount. So a few more items on FHA, but a great loan.
Great loan?
Yeah.
Mm-hmm.
All right, let's talk about VA now. The veterans.
Great loan for veterans.
Yeah. If you get an opportunity like that loan, the VA loan, if you're a veteran, you need to call us because it's zero down financing, right? There is no zero down, and there's no monthly PMI on that loan at all. Yeah. So they actually do that's a real good service for the veteran, or a benefit. And I would say that in some situations, if they've owned a home before, they may not want to use their VA again. A lot of times people just say, hey, I want to use my VA because they're veteran, they're proud of that. But in some cases, it's not as good a loan. Down the road, if you're putting money down, if you're putting maybe 10 or 20% down, it may not be as good a loan. But in most cases, especially your first-time home buyers, if you've got VA eligibility, let's talk and we'll help you get in that loan. And it's zero down. Right now, we got sellers paying closing costs. I mean, you can legitimately move in a house on a VA loan with no money out of pocket. And you know what? You're gonna have to put the earnest money up. There was like earnest money is usually like 1%. So, you
can get that money back.
Yeah, we can actually get enough closing cost if the seller, if we can negotiate it, get that money back. So you can legitimately come out of pocket with zero.
Yeah.
Heck yeah. Now, for the people who qualify for veteran, so obviously if you served, first of all, thank you very much.
Amen.
And,
yes, thank you.
I think so. It's also immediate family members as well, right? Like your spouse. And like your spouse.
Well, the spouse can be on the loan, so you can have your spouse on the loan.
Like say for heaven forbid somebody served and then they passed away.
Yeah,
right?
yes.
Like
surviving
their spouse could.
Yes,
right.
surviving.
That's where I'm getting.
Yeah, sorry.
Yeah,
I'm a little slow over here.
Come on. You didn't work out.
I did work out, but
because I gave you my
leave it at that.
Yeah,
sometimes I don't get enough sleep.
Yeah, okay. I gave you my sweaty band. Yeah.
We were on VA, so VA is a great loan, and if you're a veteran, you need it. Like I'm telling you, that's a great loan, and sometimes the rates on VAs are actually even lower than they are on conventional. So the really good loan.
Mm-hmm.
So
just because it is 0% down, you can still put a down payment, which will lower your funding fee from VA with the down payment. But those are things we go over with the borrowers too.
Yeah, we'll dive into all that. It gets deep.
Yeah.
So if you haven't figured it out yet, guys, these gentlemen know what they're doing. So if you just have any questions, you might as well just give us a call, shoot us a text, send us an email. Jump on our calendar if you want to jump straight with a Zoom. I can connect you with these guys too. So that's what we're here for, just to provide some education, get you the answers that you're looking for. Okay. Let's move on to USDA loans. So if you're looking at moving out into the country a little bit, picking up some land out there, you can get some agricultural exemptions.
Right.
That's 0% down as well, right?
Yep. That's a zero down loan, and USDA is not part of the meat.
Yeah.
When I first saw that, I was like, "What? What does the meat quality have to do with a loan here? What's going on here?" So USDA.
I was like, "What is he talking about?"
USDA, right? That's meat, right? You know how you see that on the package for meat? No.
There you go.
Am I wrong?
No, you're right. You're right.
Okay, I am right.
Yeah, you're right.
I feel like I'm right here.
You're right.
So, but USDA loans are.
We weren't that smart to figure it out. Yeah.
See, you guys need to wait.
You went from slow to way faster than
I just shot up. Man. It happens. So USDA, obviously more in the rural area loans. It was built. It's really not in rural areas now because they do the consensus every 10 years and they determine the amount of population, and that's how they determine whether it's going to be a USDA loan or not. Well, everything grows so fast out here. So you got all these huge neighborhoods and like just north of 380 and some areas as well.
I mean, like Salina is projected to be, so Salina population is 30,000 right now, projected to be, it's got space for projected 300,000. So it's literally going to 10x over the net. I don't know how long that'll take, maybe a decade or two or so. Like it's going to be about the size of Plano, which if you've watched any of our videos on Plano, you know how huge Plano is. So it's going to be another Plano up there, and a lot of that is USDA up there.
We were doing loans in 2012. Little Elm, right? Mm-hmm. Was USDA,
yeah, it was USDA.
And now,
now it's like in Dallas right now.
Yeah,
Frisco's little brother.
Exactly. Wants that is our little brother. Yeah, I'm from Frisco, and that is our little brother.
Yeah.
Little Elm. We like those guys.
Yeah.
So we pick on them a little bit, but so the USDA loan is very cool. So the USDA loan has got some super unique features, with a zero down option as well. So one of the another real big positive on the USDA is if you get an appraisal and it comes in higher. So for instance, I'm buying a property and let's say it's $350,000, and let's say the appraisal comes in at $355,000, you can actually roll in your closing cost into that loan. Nice. So it is set up to where you can roll them in. That's the only loan you can do that with. So
that's awesome.
So, again, you can have seller pay closing costs, but you may not even need it. You could just roll it right into your loan if you wanted to come out of pocket with absolutely zero again.
Yeah, and one thing to think about is the income limitations that you have of USDA. So it's per household, and it has an income where you can only make so much if you're one person or two people in the household, and I think goes up to 5, right?
Right.
Yeah. So something that the lender needs to check on is to make sure that the total income for the household is within those guidelines.
Yeah, I wanted Daniel to give you bad news. I was going to give you all the good news.
Yeah, yeah.
Good.
Hey, you got to give all this transparency
right,
here.
Right.
Yeah.
Well, I knew I was going to give it. I was hoping you were throwing that in.
Oh, okay. Yeah.
That's a bunch of negativity.
Yeah.
Negativity.
I feel like you know, some of the USDA.
By the way, great loan. It's a great loan.
Keep it positive.
Yeah.
Positive vibes.
It is a great loan.
But I feel like you know, USDA, a lot of investors who are looking like a long-term play is something that a USDA loan might come into play. No.
So you got to be a primary resident only to buy a USDA.
So you have to live in the house.
Mm-hmm.
Have to live in the house,
Okay.
and you cannot own another home and get a USDA loan.
Okay, that's
So
interesting. I did not know that.
It's legitimately a first-time home buyer loan.
Okay.
Hey, you're giving some negative information there. Yeah.
I apologize.
Yeah.
That was
Buzzkill.
actually Daniel.
Yeah.
I took over his segment there.
Yeah.
Okay.
But which helps, you know, most likely that's going to help with the values. You can't have investors go in and rent out the
Right.
properties and
Right.
so on. So it's good for the communities. Yeah.
Yep.
Well, you know, it could be a personal investment for like a, you know, like say in Salina, like, hey, I'm gonna buy this out. I'm gonna live here for 10 years.
Yeah.
And then after
Right.
that, you know, I'm gonna make.
I know people that do that. They're like they live there for like 3 years and they go buy another property and they keep that other property and go do it again and do it again.
Mm-hmm.
Yeah. Awesome. Okay. I think we're good on that one. Yeah.
Yeah.
So let's talk about the foreign national. Daniel, I'll turn to you, Mr. Mr. Sweden over here.
Right.
Mr. Sweden.
Varish.
So the foreign national, that's the one where we have, you got to have a visa to work. But you, Jeff, you I think you just did one, right?
I just did one.
Yeah.
Yeah. So, you know, foreign national is more like if you're living in another country and you're buying a home here. So if you want to buy like a second home or investment property, that you're going to have to do it as a foreign national if you're not going to actually live here or work here. So, you know, it's a very tricky loan to do because in different countries, sometimes it's very difficult for us to verify their income over there, right?
So there's two investors. One require a visa and one does not require a visa. So it depends which one you go with.
Right.
And yes, it is tricky to determine the income. It's going to be tax returns if you're self-employed, and all the documentation would have to be translated. But it is possible. Usually it requires 50% down payment.
Give or take on that.
But if you have an international credit report, you can go with a 30% down payment.
Right.
And they, again, these guidelines, they change over time. So that's where it is right now.
Right.
But they do fluctuate depending on how the market changes and so on.
If you're watching this from like another country right now, one thing I would
Which does happen.
Oh, it does. Okay, cool.
Yeah.
Then I would suggest go make sure you have an I-10 number. So you have to have an I-10 to get a loan, period. So even if you don't have a visa, you still have to get your I-10, which takes, I don't know, like a month? Something like that. I don't know how long it takes.
What is an I-10?
Okay, yeah, good question. So that is an ID number that you use, like, so if they have mortgage interest, they have to have an ID, like a Social Security number normally.
That's right.
So it's an alternative to a Social Security number. So if you can actually, there's people that work here in the U.S. that don't have a Social Security number, and they file their taxes with an I-10 number. So they actually file taxes with the IRS. They pay taxes, and they don't even have a Social Security number.
And that's not an I-10. It's an I-T-I-N.
Yeah.
I-T-I-N. There you go. Yeah.
I don't know what that stands for. I'll have to
I don't know.
look that up. Doesn't matter.
I can make up something really
But
fast if y'all want me to.
If you say I-10, people know what you're talking about.
They do. Yeah.
And on those loans, it's just recommended to send us all the documents so we can contact investors that are doing these loans, because they will require more background check and more due diligence. Up front, exactly. Yeah.
Okay. Now, so we're going off of the flyer that you guys have for the different programs. Mm-hmm. There's also an I-10
program. Yes,
Mm-hmm.
yes. Like I was just saying, like
that.
There's people here in the U.S. that don't have visas and they are here without a Social Security number, but they're working. They actually work, file taxes, and we can actually do a loan for them. In some cases, as low as 10%, but in most cases, it's 20% down. The idea of that still blows me away, but I love it. I love it.
Awesome.
Supposedly those loans are performing really well too.
Yeah. People that get opportunity to have home ownership over here from like other countries, they they appreciate it more than anybody, and so those loans perform like really, really good.
Awesome. Okay, let's talk about portfolio lending.
Okay.
Oh,
So there.
yeah.
So should we start with bank statements only?
Yeah,
So
go ahead.
Yeah. So if you are not showing too much income on your tax return,
Self-employed people, the number one thing, if someone's self-employed and they own their own business, like, hey, I make a lot more money than what's on paper here. I think they say that every time. I don't know.
Yeah.
I can't quantify that, but I may hear that 100% of the time.
I have to be careful how I phrase that. Yeah.
Yeah. Not that we know that happens, but basically they're, trying to tell us, hey, we make, and so in some cases, they're writing off a lot of stuff, which, that's
part of it.
Yeah, part of it. And we're okay with that. And we're used to that. So, we have to evaluate can they qualify based on that amount they show on paper. And if they can't, then a lot of times what we'll do, we have programs where it goes based on how their deposits from their work. And we
12 to 24 months bank statements from the business.
Yep.
And then we look at how much the deposits are, and you determine what the true income will be from there.
Right. We do. There's calculations. We can use a percentage of those deposits as actual income. So in the case where someone's writing off a lot, we would go the bank statement loan. The negative to that loan, and I'm going to take Daniel's place here on the negative.
Thanks.
Is that the rates are a little bit higher on those, and the down payments are usually a little bit higher. So you got 10% minimum in some cases. But
recommended 20%.
Recommended 20%, and the rates are a little bit higher. But a lot of times we tell people, get into the house with this loan. Everybody's like, well, the rate's higher, and I don't want to do that. Well, even at a higher rate, the appreciation on the house is going to cost you more than the difference in rate. So get in the house, and then we'll talk to you about, make sure you're following enough next year, and then we can qualify you. Did I say that on the record? I did. And then we can qualify you next year, refinance you out of that loan into a better interest rate.
Yeah.
So I think that's a good segue to let's keep it moving into the ARMS loan. Okay,
ARMS.
I think that's a good segue into the adjustable rate mortgage.
So on the ARMS, so we're seeing more of that now in the jumbo market than in the conforming or the conventional loans. So if you're below the 647, people tend to stick to the 15 or 30 year more fixed. Right. But once you go over to the big higher loan amounts, then the ARMs are more popular. And so you can do the 7-year ARM, the 10-year ARM, and so on. There's a lot of different ARM options there, and the rates are lower on the ARMs than if you would go with the regular fixed.
And that was going to be my question. Sorry, if you don't mind. It was, well, why would I do an ARM if I could just get into a rate and then have the option to refinance later on if it's lower? But you're saying the rate is typically lower, or there's like a what is it called, that period, that initial period?
The 7 years or 10 years, depending on which type of ARM you pick, right?
It's how long the rate is fixed. So you have a fixed rate for either 3 years, 5 years, 7 years, or 10 years. So there's those different options depending on the loan program.
Yeah.
And then after that expires,
and then it adjusts
to
whatever
the market.
To the market. There's an index tied to your loan, one of the market indexes, and then there's a margin which you add that on top of that index, and then that whatever it is at that moment, when it comes due, is what your interest rate's going to be. There are caps on that too, by the way.
Yeah.
So that means that there's a maximum it can go up. So if the rate's shot way up, it's not going to necessarily go way up. It can.
That'll be the next topic. That's a lot of items in the ARMs.
Yeah, we can unpack that one for a while. But, the ARM is a good loan if we think someone's going to be in there short term, and you ask the question, why don't just refinance later? Well, the difference with refinancing later is that there's fees involved in that, right? And also, we don't know what the rates are going to be later, right? So we can't predict down the road the rates are going to be lower. We don't know that. We hope so, but we don't know that. And so I would say an ARM is a good loan if it's short term. And we're going to talk through that. We'll see what the differences are, because a lot of times people, I plan to be here 5 years, but it may be 10 years. Who knows? So we talk to them about that.
What's the difference in the rate, from a 3-year to a 5-year, 7, 10?
Right. Yeah.
Like how big of a difference?
It's about a quarter of a point between those.
Each one? Okay.
Yeah. Sometimes an eighth to a quarter of a point in between those different.
Okay.
So it again depends on the loan type that we're doing. There's a lot of variables in there. So credit scores, there's just so many little variables in there.
Down payment,
right?
everything.
Yeah, there's a lot of variables in there to what that spread is.
Yeah.
So.
Now, I think one thing that people get,
we got to be careful. Compliance is watching us. Yeah.
There's all kinds of compliance going on here.
So, one thing I think people get frustrated sometimes with is the amount of paperwork and documentation they have to send in to you guys. Oh, Daniel, you need more? What?
Yeah.
Right.
Well, we can blame 2008 for that.
Yes.
And blame Jeff for
I took responsibility
last time.
Yeah, I took full responsibility for the crash in 2008.
It was all Jeff.
Thank
you. He's kidding, by the way, just to make sure that's clear. But I think but it's I mean, that's now a good thing. So we can avoid something like 2008 happening again. But it will be just to kind of set the expectation. You're gonna have to provide the documentation that's needed.
Yeah, and what I tell my clients is like, the more income sources you're using, if it's pension, Social Security, W-2s, right? We're going to have, if you're using all those income sources, we have to see documentation from all these particular sources, right? Mm-hmm. If you're only using W-2, well, it's easier. But if you're pulling income on your tax returns from 7-8 different rental properties, well, we need documentation based on that. So what I tell clients that are very successful, unfortunately, the more successful you are, the more income sources you have, the more documentation we need. It doesn't matter if you have several millions in the bank. We look at where the income is coming from, and that's how we have to break it down as lenders. Right. So it's a little unfortunate for them because, it gets frustrating when you have 7-8 different properties, you're self-employed, you have 3-4 businesses, and you're all using that as income. Well, now we need to see documentation on that.
Yeah. They should have accountants that
they do, but but it's still a lot more documentation than if you just have a W-2, right? If you've been with the same company.
And one thing to note on that, so when we evaluate and we start doing income, Daniel and I are saying, okay, what income do we actually have to have? So there may be other income sources we don't even need to qualify, and so then we won't ask for the documentation. So Daniel and I actually go through and try to minimize the amount of documentation we need from you each time. So whereas most companies, they're just very generic. Okay, you have that, we need this. And so we're actually trying to help streamline the process for you a little bit. And you mentioned something, and this comes up a lot, and they're like, hey, well, I got enough cash in the bank to pay for the house, but it doesn't matter. You could have $1 billion in the bank, and they still were going to require the documentation.
And I think that's a big frustration from some borrowers is, hey, yes, they have a lot of assets, but we still got to verify the income, right? And that's when it gets a little frustrating. And I get it, because common sense says, hey, they have a lot of money, they're successful, they're doing well, right? But we still have to follow the guidelines for the particular loan that we're choosing.
Yeah, Dodd-Frank changed all that for us.
Mm-hmm.
Yeah.
Appreciate those guys.
Yeah.
Yep. So, all right, let's talk about the final topic of the day, which is the potential 40-year mortgage.
Ooh.
Yeah.
What do you guys think about that? Would you do it? Let us know in a comment below. Would you take a 40-year mortgage, or would you just stick with the 30-year? Let's talk about it, gentlemen.
Right. Well, 40-year, it's not a very popular loan, I can tell you that. So, and so when you really dive deep into the 40-year mortgage, really what's going on there is it's going to be a higher rate mortgage. So it's kind of a niche type program, and like if you have great credit scores and you're putting 20% down or 10% down, and we can verify your income and all that, like a traditional loan that we do, you're not going to want to probably do the 40-year mortgage because the interest rate on it's just so much higher. And give you an example, I don't know exactly what it is, but it may be like 2% higher than a typical rate.
Oh, that's a lot.
Yeah, and as of now, we're seeing that mainly for the niche programs,
right?
Where if you can't qualify for one of those regular loans like conventional, jumbo, FHA, and you have to go with those are the ones that are offering the 40-year. Yeah. So it's not very common, but it is out there.
It's a necessity loan more than it is I choose that loan.
Yeah.
Yeah. So it's not like you know, I think a lot of people might think, oh, 40-year
right
at the same rate. Oh yeah, let's do it. Well, not quite.
Yeah.
And when you're looking at your amortization schedule, which is how much is paid towards principal and interest each month.
Yeah.
I mean, on the 30-year, there's not a lot going towards principal. You do a 40, I mean, you're almost renting.
Yeah. That's a good point. Yeah.
Almost.
Yeah.
True. So, okay. Well, I think that wraps it up.
Yeah.
Is that it?
Gentlemen? Yeah, that was...
What's the summary here?
Hang on.
Yeah.
These are some hot topics in here today. It's gonna be sweatbands.
So the summary is there are a lot of different loan programs out there,
Right.
and to contact us, and
Right.
we help you determine, hey, here are your options. We put a plan together, but where it starts is we need to know what you as a consumer, what you want, and
Right.
we can figure out the loan around that.
Right.
Yeah.
Couldn't have said it
I'm just gonna,
any better
I'm just going to
myself.
say yeah.
Yeah.
That's all I got.
Yeah.
See, that was a positive ending, wasn't it? Yeah.
Right.
There we go.
Yeah.
Golly, I'm the negative guy now.
Yeah.
Jeez.
All right, ladies and gentlemen, well, thank you for hanging out with us today. If you did find value from this, please tap that like button, especially if you made it this far. Make sure you are subscribed as well. I'm telling you, you do not want to miss the next video that we drop, so make sure you tap the notification bell as well while you're down there. Yeah, again, all of our contact info is in the description down below, so make sure you get at us if you have any questions, if you want to start that vetting process there. And if you don't know where to go from here, you should see some videos popping up on the end screen that can definitely point you in the right direction to get you started. Of course, we've covered just about every inch of Dallas and Fort Worth at this point here. So, you know, whichever one of those is popping out to you, make sure you click on that. And until the next video, we'll see you around town.